I am really impressed how little people in traditional finance think outside of the box. People are hyper-focused on the Fed meeting, people are hyper-focused on the unemployment rate, people are hyper-focused on whatever the inflation rate is, the officially important inflation rate, but people don't really think about what are valuations really about. Because what does this mean that interest rates go up? It means that we have to discount our future cash flows more. So when interest rates go up, that means that bonds pay higher coupon in the future. If you currently hold a bond that maybe pays 2% every year, you bought it a few years back, right? It pays 2% every year, and then the interest rates rise. Now you could have bought a bond that's paying, say, 5% every year. So the bonds that you're holding that only pay those 2%, they're now worth less to you, because nowadays you can get, with the same risk, higher paid bonds. So in traditional finance, bond payments are seen as the risk-free rate. When you have a stock, then you get dividend payments, you get shares of the profit of a company. That's risky. But when you get the payment from the government in forms of bond coupons, that's not risky. So whatever you get in the stock market needs to be discounted by whatever is risk-free in the market. And the further that cash flow is out in the future, the more you have to discount that cash flow, because a dollar today is worth more to you than a dollar, say, in 20 years. So when the risk-free rate is, say, 5% today, you have to discount the cash flow in 20 years by 1.05 to the power of 20. You have to discount it a lot. The more the interest rate rises, the more you have to discount that future cash flow. That's the traditional financial theory. And because we have seen rising interest rates in the past, there's no surprise that bond prices went down. They went down a lot. This is SPTL. This is an ETF, an exchange traded fund for long duration government bonds. So if you held bonds in the last 1 to 2 years, you'd be down in US dollars if you had to sell those bonds today by 50%. The value of those bonds went down by 50% because the interest rates rose, and nowadays you can buy better bonds. Now, if finance is your thing, then everything that I just told you was no surprise. But most people, unfortunately, stop at this point. They simply think, okay, interest rates go up, bond prices go down, that's the whole story. But what's really happening? The long duration government bonds suffer the most, right? Because they've got most of their cash flow far out in the future. You have to discount them the most. The short-term government bonds aren't that much hurt when interest rates rise. But that's where most people don't continue thinking. This video is sponsored by the premium membership. I never take any money from any crypto project. I never take any affiliate links from centralized exchanges. I never pump and dump coins. Instead, I offer valuable tutorials in the premium membership. Feel free to check it out. The exact same effect should be applied to stocks as well, especially to the stocks that have a lot of their future cash flows far out in the future, especially to the tech stocks, right? Tech stocks have a lot of growth in them. A lot of people simply just think that most of their cash flows will be far out in the future. In other words, the impact of rising interest rates should be the exact same for long-term government bonds and for tech stocks. Again, those are the long-term government bonds. And here we've got the Nasdaq. Looks very different, right? Did not go down at all. Is very close to the all-time high. Now let's assume the market is somewhat efficient and that the same kind of effect happened for tech stocks. The only difference is that tech stocks have the opportunity to make more money, to make more profit. So the reason why the tech stocks are not down is because the market anticipates that the future growth of those cash flows will be more than whatever has now to be discounted with those rising interest rates. Another way to look at this is, if interest rates hadn't risen, then the Nasdaq would have to be way, way higher. And we can actually adjust for this now. How about dividing the Nasdaq by this SPTL ETF price? So when long-term government bonds go down by 50% because of the rising interest rates, but tech stocks do not go down, the market anticipates a lot of growth in profit and in dividends of those tech stocks. And if we remove that effect, right, if we remove the interest rate rise effect, then we can actually see what the market is anticipating in terms of cash flows, in terms of dividends for those tech companies. You're now about to see a chart of anticipated cash flows for tech, of real valuation of tech, if there hadn't been any interest rate rises. Something that you have never seen anywhere else been done. This is the out-of-the-box thinking that I think is lacking in traditional finance. Look at this. The global financial crisis in 2008, and since then a very constant increase year to date. The anticipated profit for tech stocks in their lifetime, measured in fiat, went up by 67%. Measured from beginning of 2022, the Nasdaq went up by 55%. Measured since 2021, it went up by more than 106%. So in less than 3 years, a doubling, but just measured simply in Nasdaq points, only up by 26%. Isn't that fascinating? The market anticipates now, compared to just less than 3 years ago, that the profit of tech companies will more than double, measured in US dollars. But the Nasdaq itself is only up 25%. And that's because interest rates went up, depressing the prices, especially of tech, but still people are hyper bullish on tech. I've never seen anybody else making this kind of an adjustment, this massive adjustment that's required because discounting went up massively with those increased interest rates. Otherwise, why are the bond prices going down that much, right? Bond prices are fixed payments, you have to discount them a lot, and that's what we see. The same is true for tech stocks, but people simply just don't discount them in the same way, or at least they are not adjusting for that impact. Now, as an extension of that, we could also apply this to property prices, for example, right? Because property prices, the value of a property, is whatever kind of rent payments are expected in the future. The sum of rent payments in the future is whatever the current value of a property is. And yes, that's also very long term. And yes, this should have come down also by 50%. And no, it did not come down yet by 50%. So people are either anticipating for rents to come up a lot, or alternatively, property is simply just overpriced and people didn't realize this yet and people didn't sell yet, even though they should have. Let me know if you'd like to have a separate video on these property price adjustments as well down below. Feel free to also subscribe, and a like would be very much appreciated as well. I publish videos here regularly and it will help the channel grow. There's also a Telegram channel, link is down below.